let's continue. From last week, we started with introduction to national income accounting. I didn't actually go deeper because I know that was our first meeting. But today, I want you to pay a particular attention to whatever we'll be doing here. Take your pen, take your book and everything, and let's start. So last week, I introduced you to the foundation or the history of what macroeconomics, how macroeconomics came about, some people or pioneers of macroeconomics, what macroeconomics entails and everything. So today we are going to dive deeper into what we call a component of macroeconomics. Now, when you go to microeconomics, I told you microeconomics comprised of so many components. When you go to the microeconomy, we look at individuals, we look at firms and all that. But when we come to the macro part, which is the aggregate part, we look at some components such as consumption and others. So in this context, I don't know if you all have this particular slide. I shared it on all the pages and I shared it so that you could go over even before we start. Okay. So if you have any question from what we did last week, you can ask me now, else I'm continuing. Any question from last week? Okay, no question. Then let's go. Now, when we say national income, going forward, you will see that national income is a way of measuring what you call, is a measurement of what GDP, going very forward. If you want to measure GDP, what's GDP itself? We will analyze that one later. We get to understand what comprised of GDP. I'm sure you are familiar with it and you've gone to lectures, you've gone for other things or you read things on your own. But I'm hoping that maybe today, by the close of this tutorial, you will learn something new. So anytime you hear of national income, the key word here is what? Income. What is an income? Income is something we generate from rendering what? Services. So when we say national income, we are looking at the various avenues by which income flows. So if you work, you as a student, you work for a company, and if they pay you, somebody also works for a company, they pay them. Let's say we are all working for a company, they pay us. By the close of the day, or by the close of the year, we can accumulate that, okay, this year my national income was what? For this particular amount. You get it? Or my national income was this. That was meant by national income. Now, in measuring GDP or in analysis of every country, we don't really look at what we call the national income. We look at what we call the GDP. Okay, good. The GDP, I'm sure you might have a little idea about it already. That is a market value. When we say market value, something that we paid for, or something that you did, or something that involved what you call money. Okay, so it was a free services. It wasn't captured, or isn't a market value. Market value is something that comes with payment or something that you pay for. So market value of all goods and services that are produced in an economy at a particular time. And in this context, I'm going to explain to you the component of GDP and then some measurement of GDP. So that is what will comprise of this tutorial or this short meeting. Measurement of GDP and the components. Now, if you want to measure GDP of any country, you want to measure whether this economy is growing or this particular economy is coming down, we look at the country's GDP. So last week, somebody asked me if you want to analyze the well-being of any country, we can use the GDP. Yes, we can use the GDP, all right. But sometimes GDP may lie to us that the economy is growing or people are actually living a very good life. But it may not be so. People may be struggling low-key. So, but since we don't have any other means of measuring or any standard way of measuring the standard of living of people, we look at the GDP of a country and we estimate that, well, this country is what is actually benefiting from something. Okay, so GDP measures the total income of everyone in the economy. When you say total income, I told you, income is something that comes in, we generate. So if you want to measure GDP of any country, we can use what we call income. Going forward, you see that income is a measure of what? GDP. You look at how much people are receiving and how much they are spending. Okay, to measure GDP, you know that, oh, okay, these people are receiving 1,000 Ghana cedis every week. These people are receiving 1,000 Ghana cedis or 2,000 Ghana cedis every month. And we know that, okay, this is the standard of living, and these are the prices of goods and services. So we can say they are what's better off, or they are having a peaceful economy. Who just came in? Kindly mute. So we can say they are having a good standard of living. That's what to mean by when you want to measure GDP by what you call national income. Okay. And you could see here that for an economy as a whole, income must be equal expenditure. What's expenditure? Expenditure is what you spend on. So if I'm going to the market and I know I'm going to buy shoe, I'm going to buy dress, I'm going to buy milk, I'm going to buy Milo. These are my expenditure, or these are my expenditure. So I just list them down and then I go into the market and buy them. Now, in any economy, we assume that what you get is what you spend. So if you get 1,000 Ghana cedis, you're going to spend what you call all 1,000 Ghana cedis. So going forward, you realize that if you want to measure any economy, we have what we call the income approach. We look at how much people get, or the expenditure approach. We want to measure GDP. We can use the expenditure approach. We want to know how much people spend on goods and services. Please, are you following? Who doesn't understand anything here? Or am I moving too fast? If you have any concern, please let us know so that quickly we draw or we help you. Okay, so we are good. Let's continue. So in any economy, we assume that income must be equal to expenditure. Yeah, economics is basically about an assumption. So don't assume that what I'll get at the end of the month is what I'm going to spend. Sometimes we spend, sometimes we save, right? Good. So that's why they are saying that every transaction has what? A buyer and a seller. So if you want to measure GDP of a country, we can look at one side, your income you are receiving by the close of the year, or we look at how much you spend by the close of the year, because we have that assumption that what you get is what you spend. You get it? So that is basically our assumption about the national income approach. What we get is what you spend. Okay. So I'm sure all of you are familiar with what we call the circular flow diagram. Who hasn't seen this thing before? I'm going down because it's a similar thing. They summarize everything here. Who hasn't seen this thing before? Or who doesn't know this? You all did it in, how do you call it? Microeconomics last semester. So I'll use just 2 minutes to summarize it. Maybe somebody didn't understand, but it is a good way of getting it. Now, this circular flow diagram is used in both micro and macroeconomics. Going forward, we are going to have what we call government here. Okay, this comprises of just two people. We have firm. Firm is company, or let's say a shop. And we have household. Household comprised of you and I. We go to the market, right? And we have two markets. We have what we call the market for factors of production, and we have what we call the market for goods and services. And what are these markets? Now, if you look at household, let's take for instance, as a human being, what do? You go here to what? To buy goods and services, right? Where you go and buy your goods and services, you go and buy your gari, go and buy your Milo, is what we call the market for goods and services. Okay. We also have firms. Firms go and sell here. So you as a household, you go over here to buy, but the firms go and what? Sell, because they have produced the goods and services. So where we buy and sell these goods are what we call the market for goods and services. And at this market, we sell what we call finished products or ready-made products. It means goods that are being produced by what? These firms. Now going forward, let me come here. Market for factors of production is from the word factors of production. What are the factors of production? They are here: land, labor, capital, knowledge, and rent, right? So we have household who are willing to sell their knowledge, who are willing to sell their skills, who are willing to sacrifice so many things and bring them here. Now, as a firm, as a company, you need human beings to work with, right? So the firm will come to this point, come and how or buy from this part, and then they'll be able to produce their goods and services here, and they'll be able to sell them at the goods market. So this is called the goods market. This is called the factor market. So in case you are solving or you hear of GDP, you're saying factor market, you're talking about where the factors of production are, like labor, capital, and all that. And when you hear of goods markets, okay, that's what you're talking about, this part. I'm sure you are familiar with this one. We did last semester, so I wouldn't waste time. Up to now, who doesn't understand this thing, please? The secular flow diagram, it works. You know it, eh? So, like I was saying, going forward, you're going to bring government here. What's government show? Government will come into what? To take taxes from household. Level 200, you'll be doing it. Government will come here to take household tax from firms and what? Household. Okay. And they're even going to talk about banks. Banks will also come in. People are going to save. You're going to have what to call the external sector. But you are in 100. So our focus is just two sides, the household and firm. But I want you to understand this market very, very well. Okay. So like I told you earlier, how do we calculate GDP? We calculate GDP by adding up total purchases of household. This is called the expenditure approach. So I'm sure you've all gone for lectures and you've heard what you call expenditure approach. Expenditure approach is you go to the market. Let's assume, let me use somebody's name. Whose name applies first? Okay, I'm seeing Priska's name here. Now let's assume that Priska is working. Okay, at the end of the month, she's paid 2,000 Ghana cedis. And we assume that Priska spends all her 2,000 Ghana cedis. Now, Priska, every month, she buys, let's say, food, she buys petrol or fuel, she buys all that. Okay, now if you want to calculate Priska's, let's assume that we don't calculate individual GDP, but if you want to calculate Priska's GDP, you have to add up all the expenditure by what? Priska. And then we can find out that, oh, okay, so the whole year, Priska spends this total amount. We get it. The same way also, the same way, when we want to calculate GDP of any country, we look at how much the economy spends. If I say the economy spends, you're talking about government, how government spends its money, how individuals also what spends its money, and then we add them up. So if the government constructed a road, the government built a hospital, the government did something, we are going to add all of them up. Who is here? We are going to add all of them up, and then we know that, oh, okay, so this was the total expenditure that we incurred. Now, if we have the expenditure should be equal to what? To total income, because we assume that what you get is what you spend. Put that one at the back of your mind. Anytime you hear of expenditure and national income approach or income approach, what you buy is what you sell. Okay. And they're asking us, the model, is it realistic? No, it doesn't work. This model doesn't work. That's why it says sometimes the money comes in, we save some, we invest some get low, people also dash us money and all that. Okay. Is any question? Any question for me?
Hello.
Yes. You can ask the question.
Oh yeah, so we can move on.
Okay. So here they are going to explain GDP. Here they are asking us what are some of the limitations of the circular flow model. We've done it already, so I don't want to really go over there. So,
hello.
Yes. Ima.
Please, I have a question.
Okay.
Yes. Please. I want to ask that. If the cost of externality is also part of GDP or what? Example, like if let's say a factory is producing, then let's say there are activities. Let's say smoke from the factory.
Okay.
Maybe polluting the environment, and then the government issues some money to channel this smoke to a specific direction so that it won't affect the environment again. That expense made by the government, is it part of government expenditure as in the GDP calculation?
Yes, any amount, let's assume that, of course, there was a disaster somewhere, or there's a disaster somewhere. I beg, hey, please, we are serious here. Who is sending message? Williams, I'll you. So anytime there's a disaster, what does government do? Government will have to come in, right? So anytime when in the drawing of budgets, because something unforeseen circumstances, okay, and as a human being, I'm sure those of you who did economics in SHS, because something precautionary demand for money, government also set aside a part of income or part of the expenditure or revenue to tackle those things. So they are all captured in the calculation of what? GDP. Okay, they are all captured. The only thing that is not captured in GDP is let's say transfer payments, when that's given free of charge, but anything that will add value or anything that will make life comfortable for the people is being captured in the GDP. Yes, you are talking. Iman?
But please, economics. Yes, hello. Please,
Yes.
can you hear me?
Yeah, I can hear you.
Please, I said I read from the Principles of Macroeconomics
Okay.
by Mankell, edition 6.
Okay.
And it says GDP, it measures the country's production of goods and services. Sorry, please. It says the GDP measures the factory production of goods and services, but it does not measure the harm that inflicts on the society or the environment.
Okay. So what I understand you, but what I'm trying to say is that you see, even with transfer payments, what it does is that it even eases or it makes life comfortable for those living the economy. However, the question that you ask, how I understood from your point is that in case maybe there's a factory that is causing a harm to, let's say, a particular community of people, let's say government will want to come in by relocating the company somewhere or trying to, of course, if they want to do it, they'll have to relocate the company. And relocating it may come in the form of what? Construction or something. That is how I understood the question. But in the case where the work they are doing is unproductive, you see, when they relocate the company, it's like they are still building new infrastructures. They are still going to employ the same kind of people which should contribute to GDP. But in a case like how you explained to me, like a direct harm, yes, that one is not captured in the GDP. And it's a harm that is a government is trying to intervene to solve it so that it won't affect the people directly. But in the case of relocation, like how I've explained, it's being captured. Okay. Yes. So please take notes. Anything that is welcome. Anything that is a direct harm, that government tries to recorrect it, is not captured in GDP. Okay. Like you said, is a market value, something that should add value. But if the same government goes somewhere because he wants to relocate, and let's say, I think, is that Bugrishi or something, there was a relocation of some people. Yes. One market. Yes. When it happens that way, of course, it's being captured in the GDP. But in the case where government comes in and says, okay, you people should stop producing, and then let's do this. No. It's not captured in the GDP. Okay, let's continue. So these plenty things are explain what you call the GDP itself. Okay, I cannot go through everything, but then I'm going to give you some key points that's So when we say market value, I've explained this already. Okay. When we say something has value, it means it has a price. So anything that you pay for or anything that comes with the cost is being captured in the GDP. Okay. Say market price reflecting the value of the goods. To increase in total market, the answer is a question. The total market values always indicates increase in production of goods and services in an economy. The increase in total market values always indicates, yes, anytime there's an hello, please, Constance. If you can kindly mute yourself. Okay, let's continue. Anytime there's an increase in the value of any product or in the value of any production, of course, GDP is going to rise. Let's assume that I have a company that I was producing at we used to produce 50 tons of, or 50, let me use gallons, 50 gallons of what? A particular product. And now there has been an increase in the value that we are producing. Now we're able to produce what we call 1,000, and we are selling at a higher price. Of course, there's an increase. It will add up to what? GDP. Okay. And they are trying to break down the definition of GDP for you. Of all means a lot of items are captured in GDP. Any item that are being produced in the economy are captured in GDP, except few of them. So when I was in 100, what I did was I personally went to look out for items that are not being captured in the calculation of what? GDP. And I found out why they are not captured in GDP. Goods that are sold illegally. Okay. Here they are telling us here. Produce and sell illicitly. So anytime you produce like cocaine, tramadol sold outside, they are not captured in the calculation of GDP. And would goods, they're asking us, would goods like land, stocks, or bonds be included in GDP? I'm asking all of us. Are these goods captured in the calculation of GDP? No. Why?
Because they are not produced.
Okay. Are you sure? You see, okay, maybe you will understand that one later. Some items are included, some items are excluded. Now, I'll explain to you later why land, stocks, and bonds should be included. These are the excluded items, something that are being produced and consumed at home. You see, sometimes if you want somebody to come to your house and cook for you, you have to pay them, right? Good. However, if you yourself cook, if you're able to cook, you don't pay yourself, right? Or let's say you want somebody to come and clean your toilet for you or your washroom for you. So if they come, you will have to pay them. But if you yourself, you go and do it yourself, you don't pay yourself. So, but it's a service that you rendered, right? Yes. But those goods are not captured in calculation of GDP. Illegal goods are not captured. But land, stocks or bonds, they are captured, but they are not captured under consumption. Okay, we have a particular category that we capture them, and going forward, we will get to know them. Of all final goods means intermediate goods are not included. What are intermediate goods? Intermediate goods, they are like capital, or they are not the final product. Let's assume I want to produce, how many of you like bread like me? So anytime you want to eat bread goes through a lot of process, right? So you have to produce a particular, you have to plant bread by the flour, right? Yes. So we get, where do you get the flour? The flour is there, but the flour is not the final product. So the flour becomes an intermediate product. Here they give us example of what a table. If you want to produce a table, you need the wood itself. So the wood itself is an intermediate goods. You will need a nail. Now, after putting everything together, you get the final product. You get it? Good. So intermediate goods are not included. Only final goods or the goods that are being sold in the market. And here, goods and services. So anything that we can see and touch or any services that are being rendered. Okay. And we are saying produce goods and services that are being produced. So sale of new house versus used goods. Please, used goods are not captured in the calculation of what? GDP. Okay. So used goods are already captured in earlier GDP. So if you come and include them in the current GDP, like let's assume that I imported a car, okay, costing me 10,000 Ghana cedis. And later, somebody wants to buy the car. Now, if the person wants to buy the car and already the 10,000 has been captured in Ghana's GDP, if I'm selling to somebody at, let's say, 7,000, and they want to calculate the same 7,000 and capture it in the GDP, it will be what we call double counting. Say double counting. So it is not what used goods are not included in the calculation of what GDP. Sale of new house, I'm going to, in the subsequent slide, I'm going to show you where they fall. Okay, somebody's hand is up.
Yeah. Please, we're calculating for the GDP.
Come again.
Narcotic products. Are they also narcotic products? Are they also calculated?
Okay. Okay, so narcotic products, some are, like I told you, some goods are illegal. Okay, so some goods are legal. Are you aware cocaine is used in the hospital? So cocaine that has gone to the right channel is being captured in GDP. But narcotics or drugs that are not permitted by the Food and Drug Board, people don't do business openly. And once the business is not done openly, it's like a black market. So those goods are not captured in GDP. Okay. Okay. And the last part of GDP that you should know is that it should be produced within the economy. It shouldn't be produced outside. Okay, GDP. So if we have somebody from Ivory Coast who is in Ghana producing the goods and services in Ghana, that part is captured in GDP. We have somebody from USA who has established, we have a lot of foreign companies in Ghana, hotels and all that, who is producing goods and services in Ghana. Of course, they are captured in calculation of GDP. Okay, so going forward, you understand what to mean by GDP and GNP. So GDP include anyone. Now, goods that are produced from outside are not included, except those that are produced inside the economy. Please take note, goods that are produced inside the economy. If your father is coming from outside and he brings a car, there's not captured the calculation of Ghana's GDP. If your mother brings you an iPhone, it's not calculated, it's not captured in the calculation of GDP. However, if we ourselves, we're able to make a new phone for ourselves, that one is included in the calculation of what? In GDP. And GDP can be calculated either a quarter or even on a monthly basis and even a whole year. Okay, so who doesn't understand anything so far? Who doesn't understand? So, yes, your hand is up, Brian. Kindly unmute and talk.
Yes, hello.
Yes, I can hear you.
Yeah, with the GDP. When
Okay.
I said when there are foreign goods, it's not captured in the GDP.
Yes. GDP is
But is it captured in the
okay. Go on and ask.
but is it captured in the GNP?
Yes, you will get to that. When we get there, you'll get me better. Okay. Okay. So I'll talk about GNP,
Okay.
but I understand GDP comprised of only goods that are produced only in Ghana. If somebody is bringing goods from outside Ghana, we don't factor that one as part of GDP. Maybe we can talk about GNP later. Even in the GNP, we look at the fact that those people coming, are they Ghanaians? You get it? So let's get there. Because the meeting will end in 2 minutes time. So when it ends, we join and we quickly go over again. I mean, we are continuing. So they are asking us these questions. Okay, let's do these questions before the meeting ends. What contributes more to GDP? Production of an economic car or electric car? You know, economic car. Oh, if you are driving Corolla, is an economic car. Ghana here, I've not seen anybody riding Lamborghini or something. Do you have anybody in Ghana with Lamborghini? So all these,
Yes.
yeah, yes, Lamborghini.
Yeah, despite have some.
Oh, wow.
Cheddar has some.
Okay, so those are luxury cars. So what contributes more to GDP? I would say as an economic car. Why? Because an economic car, when you say something is economic, it means a lot of people can afford it. So once people are able to buy it, it will get to a time that we have a lot of people buying. That will even surpass the price of what? A luxury. That's why I ask you, how many people are having this car in Ghana? But okay, let's compare those having this car. Let's compare those having economic car in even Greater Accra here. You are going to see that those with economic car, when you combine their money, is even far greater than what luxury car. So economic car produce more to country's GDP than
But hello,
yes.
but luxury car also has a higher market value. So when it's being purchased, it increases the GDP.
Yes, it increases, and that's why they say what contributes more to GDP. Well, if you want to go in for a luxury car, you see from the context of how I explain my point, if you want to look at the fact that one luxury car costs a lot, that's why I made that comparison. Like, let's compare one luxury car to all the luxury cars in Greater Accra here to all the economic cars, and we know which of them has contributed more to GDP. It add values. Okay, it actually increases. But I'll go in for economic car. Well, if you want to go for luxury car, maybe you have a different point, or you have a different way of defending your. But I'll go for economic car. Okay, so
That's a double counting.
so let's the meeting will end very soon. Once it ends,